Interest rates might sound boring, but they're like a hidden lever that moves mountains of money. When you think about it, your credit card interest rate isn't just some number. It influences whether you splurge now or struggle later by affecting how much debt you can afford to take on. But here's what many don't realize. Those rates have an even bigger impact on the economy as a whole, influencing everything from borrowing and lending decisions to investment and consumer spending patterns. Imagine this, you're at the mall and see two stores selling the same jacket for $50. $1 store offers it with no interest, while the other charges 18% if you don't pay in full within a certain period. Which one do you pick? Most people go for the no-interest option because paying extra money sounds painful. But here's the twist. Those interest rates aren't just about your jacket. They're also signals to businesses and banks about broader economic conditions, influencing lending and borrowing decisions across the economy. So how does this work? Well, when central banks set interest rates high, it's like turning down the dial on the economy's gas pedal. High interest rates mean it costs more to borrow money, which makes fewer people willing to take out loans for big purchases like cars and houses. It's like a store suddenly making you pay an extra fee just to buy that jacket. Now think about what happens when the government lowers interest rates, say from 5% down to 1%. Suddenly, borrowing becomes cheaper. This encourages people to take out more loans because they're paying less in interest costs. So more folks start buying homes and cars, putting money into the economy. But here's a crucial question. Why do governments change interest rates? Well, it's all about controlling inflation, which can erode the purchasing power of your dollars over time. When prices rise too quickly, such as food and gas becoming more expensive every month, central banks might raise interest rates to slow down economic activity and curb inflation. It's like applying the brakes to a speeding car by making loans less attractive, thereby reducing spending and investment. On the flip side, if the economy is sluggish and people aren't spending money, lowering interest rates can stimulate borrowing and investment. Lower interest rates make it cheaper for businesses to borrow money, encouraging them to expand and create jobs, thereby helping to push the economy forward. Let's take an example from history. In 2008, when the financial crisis hit the U.S., Federal Reserve lowered interest rates dramatically to near 0% by December 2008 in an effort to encourage lending and spending rather than hoarding cash. It was like putting a fire hose on the flames of economic collapse. But here's where things get tricky. Every decision has trade-offs. When you lower interest rates to spur growth, it can lead to other problems. People might take out too many loans for risky investments because borrowing is so cheap. For example, during periods of low interest rates, some individuals purchased homes they couldn't afford, leading to financial difficulties when the economy shifted or their personal circumstances changed. So how do central banks determine the appropriate level for interest rates to maintain a healthy economy without causing problems like inflation that's too high or too low or slowing economic growth? One way to think about it's like a thermostat. You want to set it just right so your home isn't too cold or too hot. Similarly, setting interest rates requires careful consideration and analysis of economic data to ensure the economy isn't overheating or experiencing sluggish growth. Economists analyze a wide range of data, including employment levels, consumer price indices, and measures of inflation. They also monitor trends in the stock market and housing prices to identify potential shifts in economic conditions ahead. Take a moment to think about it. Every time you swipe your card or take out a loan, you're part of the larger economic picture. Interest rates aren't just relevant to you, they affect everyone in the economy as well. So how do these rates get set in the first place? In most countries, there's an independent group called the central bank, like the Federal Reserve in America, that meets regularly to decide on interest rates. This decision-making process involves analyzing a wide range of economic indicators and data to determine the optimal rate for fostering economic growth while maintaining price stability. It's a bit like a giant game of economic chess. They look at all the pieces moving around and try to make the best move to balance inflation, employment, and overall economic health. Now imagine you're in that position. You have vast amounts of data and countless options. Where do you start? Often the central question boils down to this. Should we stimulate the economy more or take steps to slow it down? But here's a key insight. This isn't just about numbers. It's also about psychology. People react differently depending on their perceived financial comfort. When interest rates are high and borrowing costs increase, people might think twice before spending money or taking on debt. On the other hand, when it's cheap to borrow, individuals might be more willing to spend and take on larger commitments. This is why economists always watch out for signs of inflation. If prices start rising too fast, people get anxious about losing purchasing power. That anxiety can snowball into broader economic instability, leading to financial crises such as the dot-com bubble in 2001 and the housing crisis in 2008. To understand this better, let's look at how one rate hike affected things recently. Say there was a big spike in inflation last year, with prices increasing by more than expected. For example, if the central bank responded by raising interest rates from 1% to 3%, this might seem small, but it can have significant ripple effects on the economy. First off, the cost of borrowing increased significantly for many people and businesses. If you were planning on buying a house with a 20-year mortgage at 4%, suddenly that rate might jump to 6%, making your monthly payments substantially higher. For a $300,000 home loan, this means an additional $100 or more added to your payment each month. Next up, when interest rates rise, businesses face higher costs for borrowing, making them less likely to invest in new projects or expand their workforce. This can slow economic growth as there's reduced spending and investment in the economy. But here's the kicker. Higher interest rates can help reduce inflation by discouraging borrowing and spending. Higher costs of credit lead people to think twice before making large purchases, thereby reducing demand for goods and services. This can stabilize the economy over time, though it often comes with short-term challenges such as slower growth or increased unemployment. So what happened next? Did everything return to pre-crisis norms? Not quite. Interest rates remained elevated as inflation persisted, creating a challenging environment for businesses. Some industries experienced slower growth due to higher borrowing costs, but others adapted and flourished by finding innovative solutions to navigate the higher cost landscape. But let's step back and think about the bigger picture. How does this cycle affect you? Well, it starts with those interest rates again. If borrowing becomes more expensive, you might delay major purchases like a house or car until your finances are better prepared. This shift in spending habits can ripple through every part of your life, influencing decisions from what kind of job you apply for to where you decide to live. Now let's dive into how this impacts savings too. When interest rates go up, it becomes more attractive to save money rather than spend or invest because your savings account might offer better returns. However, at the same time, stocks and other investments may become less appealing due to higher borrowing costs for companies, which can reduce corporate profits and increase market risk. To sum up, when the central bank raises interest rates, it signals that lenders should charge higher borrowing costs. This action helps slow economic activity and curb inflation by making loans more expensive and saving more attractive. However, higher interest rates can also lead to tighter credit conditions and potentially reduce consumer spending and business investment. Now let's flip this around and look at what happens when interest rates are lowered. Imagine a scenario where the government sees signs of an economic slowdown, fewer jobs being created, and reduced spending on goods and services. In response, they cut interest rates significantly, from 5% to 0.5%. This sudden drop in borrowing costs has immediate impacts. 1. Consumer spending. When interest rates are lower, it becomes less expensive for consumers to borrow money, encouraging them to take out loans for purchases such as homes, cars, or other major expenses. Increased consumer borrowing and spending can stimulate economic growth by raising the demand for various goods and services. 2. Business investment. When interest rates are low, companies are more likely to borrow money at cheaper rates to invest in new projects or expand operations, which can create jobs and drive economic growth. 3. Housing market. Lower interest rates make mortgages less expensive, increasing the attractiveness of home ownership for many families. This can stimulate housing sales and construction activity. But here's the rub. While lowering interest rates can help stimulate an economy during difficult periods, it also carries risks. If rates remain too low for an extended period, individuals and businesses might borrow excessively, potentially creating another economic bubble that could eventually burst. So how do you balance these risks? It's a delicate line between encouraging economic growth and preventing asset price bubbles. Economists use complex models and real-time data to try and predict the optimal moment to adjust interest rates. But ultimately, it's about finding that sweet spot where borrowing costs are low enough to stimulate investment but not so low as to encourage reckless spending or excessive debt accumulation. Now let's take this understanding and apply it to personal finance. When interest rates change significantly, your financial decisions need to adapt accordingly. If rates rise, borrowing becomes more expensive, which may make taking on new debt less appealing. Savings and fixed income investments like bonds become more attractive due to higher returns. Understanding how rate changes affect different aspects of your finances can help you make informed economic decisions. Savings. Focus on building an emergency fund since high-interest savings accounts or money market funds can offer better returns than standard savings accounts. Investments. Be cautious about taking on too much risk in stocks or other volatile assets, as these can be highly unpredictable and may result in significant losses.